Hey Renter Retires, it's Adam Schroder here again with another video for you, and today we're going to talk about two metrics that don't get discussed a lot, and they are debt service coverage ratios and debt yields. Before we get started with today's video, I want to remind everybody, please subscribe to our YouTube channel, click the notifications bell. Like I tell you every time, we're trying to make you the smartest investor you can possibly be to set you on the road to financial freedom. Best way to do that is to keep watching the videos, listening to the podcast that we have twice a week. At the end of the video, if you like it, please click the like button and leave a comment telling people why they should watch it or any question or topic you think we should address in the future. So let's get down to it. The two things we're going to talk about: debt service coverage ratio and debt yield. What are they and why are they important? Let's start with the debt service coverage ratio. This is, once again, as it is with all real estate, it's a mathematical equation. And what the debt service coverage ratio really looks at, it's what lenders are looking at to see if they feel comfortable loaning you the money based on the net operating income and your debt service. So the way you sort it out is you take your net operating income and you divide it by your debt service. Now this is just your principal and interest. It does not count, it's not going to be your full amount paid if you are escrowing, because it doesn't have your taxes and insurance included in it, because that's taken out of your net operating income. So let's do an example. Let's say we have a $100,000 property that rents for $1,000 a month. Let's say we put 20% down on this property and get a 30-year fixed rate mortgage. Let's say we get a 4.5% interest rate, which is very easily gettable in today's market. That would give us a monthly mortgage payment, principal and interest, of $405 a month. That property has a net operating income of $570. I got this off of one of the brochures we have on our website, so it is a number that you can easily get when it comes to your mortgage and when it comes to your rents coming in. So it's very easily gettable number. So you have your net operating income of $570 a month, and you divide that by your debt service of $405. And that gives you a debt service coverage ratio of roughly 1.4. Now, is that good? Is that bad? Well, that depends on your lenders, but most lenders want to see something around 1.2, 1.25, somewhere in that range. This is something you can easily ask your lender at the beginning, say, hey, I'm going to be looking for properties. What kind of debt service coverage ratio should I be looking at to make sure I can get the loan? Just because the property doesn't have the right debt service coverage ratio at certain levels may not mean that you won't get a loan. You could put more money down and lower your debt payment. You could extend the terms of the loan, make it 30 years instead of 15, and lower your monthly payment. These are ways you can manipulate your debt service coverage ratio to make it more what your lender is looking at when they're giving the loans. So that's the debt service coverage ratio. Now let's talk about debt yields. Now debt yield, it's different from like cash on cash or cap rate or something like that, because this is something lenders look at because it's not changed by kind of the overall large market. The way you figure out your debt yield is you take your net operating income and divide it by the loan amount. Now, this is used more in commercial real estate than in single family. Whenever I've talked with lenders, they've said they don't really look at the debt yield. They look at your debt to income, but not your debt to loan amount. So they're not looking so much at your debt yield. But if you're in the commercial or multifamily world, they're going to be looking at this number a lot harder. So let's take a look at a property here. Let's say you have a property you're interested in that's $1 million. You put 30% down, and so you take out a $700,000 loan on the property. Now that property has a net operating income of $100,000 a year. So what do? You take your $100,000 and divide it by $700,000, and you get a debt yield of about 14.14%. Like I said before, when it comes to the debt service coverage ratio, that number can be manipulated by the amount you put down or the length of the loan. The debt yield can be affected by how much you put down, because obviously when you lower your loan amount, you're going to increase the debt yield. But it gives the lender the security of knowing, okay, if they default, and we take over the property. Obviously, we get their equity because you're not going to pay them for taking back a property. But when we take back this property, what kind of returns are we going to be getting on the money that we've put into the deal? So a lot of times lenders like to see something in the 9-10% range. Sometimes they want 11%, maybe 12%. This is another time that you need to talk to your lender and say, hey, what kind of debt yield should I be looking at? Because the last thing you want to do is find a property, spend a lot of time researching, investing, just spending a whole lot of time doing due diligence on the property. And then you go to your lender and they say that doesn't meet our numbers. Or in order to meet our numbers, you need to put down another $250,000. You don't want to be stuck in that situation. So we want you to have the numbers. You need to talk to your lenders and see what kind of numbers you should be looking for before you get started in the process. And that's how you calculate your debt yield. And that's how you calculate your debt service coverage ratio. They can both be changed by the amount of money that you put down, your loan to value. But debt service coverage ratio can be affected by paying points on your loan to lower your interest rate, putting more money down, or extending the length of the loan to lower your monthly mortgage payment. So I hope this has been helpful. I hope that it has helped you see things and get started on the right things before you get too far down the road with any investment properties. Go to renttoretirement.com, check out everything we have there on our website. You can also see properties that are available there if you're interested, or even just see kind of what's out there in the market. You can also go to renttoretirement.com/hotlist and get all of our properties sent straight to your phone via the PDF that you can see every day whenever we upload them. And also don't forget to subscribe to the channel, click the notifications bell. Don't miss any of these videos that we're putting out, pretty much every day of the week. And once I said before, please like the video, let everybody know that it's worth seeing, tell the algorithm that we're putting out good content. Please leave a comment below and we will get to it as soon as possible, and we'll see you on the next video.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.